Let me ask you something. Did you think buying a home was just getting pre-approved? Pick a house, close the deal. Well, I used to think that way too. But after reviewing over 100 mortgage files from first responders, blue collar workers, families just trying to get their first home, I learned there are 5 things that will kill a deal over and over again. These same patterns, these same mistakes, these same outcomes. And if you avoid these 5 things, you put yourself ahead of 99% of all buyers. Your mortgage payment isn't what you think it is. You know how many people walk into my office thinking they know their payment? Man, over 80% are usually wrong because they only look at the mortgage, not the full package, not the taxes, the homeowner's insurance, mortgage insurance. Sometimes you could have flood insurance or HOA. I had a couple once who thought their payment was going to be $3,200. When we added taxes and insurance, it jumped to $4,100. They were shocked. They almost walked away from the deal just because they didn't have the right number. If you want to stay in the game, you've got to know your real numbers. Understand what your real payment is, not the fantasy number that you hope it would be. And that brings me to lesson 2. Your credit decision don't pause just because you're buying a home. I can't tell you how many files blew up because someone used their credit card during the process. Look, I had a buyer who was fully approved, perfect, clean, ready to close. Then he decided, I'm going to buy some new furniture before closing. And he did it on a credit card. That one swipe raised his debt to income ratio, and the system literally kicked his pre-approval or his approval out the window. We had to scramble for 3 days to save his deal. Let me repeat this. Credit is live. Everything you do hits it immediately. You're not in a bubble just because you're trying to buy a home. And speaking of things buyers don't think that matter, brings me to lesson number 3. Where most deals get destroyed quietly, your job situations matter more than you think. Changing jobs during a mortgage is dangerous. I had someone switch from a salary position to an hourly and didn't tell me anything. Nothing. That change, that one change that he thought was, it doesn't really matter, forced us to completely rerun the income. The deal almost died because the bank couldn't verify the new job fast enough. When you switch jobs, we have to do a VOE, and your employer has to show us the new income, show us that you're working. And if they don't do it fast enough, that holds up the file. And when you are on a timeline to close, it messes the deals up. Even overtime matters. If your OT isn't consistent, lenders, we can't count it. And they don't. People think, I got a new job, I'm making more money, this should help. No. New job equals new rules. Lenders need history, payments, patterns, stability. But job changes aren't the only silent killer. This next one hurts because buyers don't even know they did anything wrong. Lesson number 4. Money isn't just money. Lenders need to source everything. Everything we have to source. That large cash deposit that your uncle gave you? Yeah, we need to see it. Large cash deposits equal big problems. People think, Malcolm, money is just money, isn't it? I'm putting money into my account. Shouldn't that be good? How could that be bad? Well, if you get this large cash deposit and I can't source where it came from, yeah, it's a problem because lenders have to prove where every dollar came from. I had a buyer who deposited $10,000 in cash and couldn't prove where it came from. That entire amount had to be removed from her qualification And that messes up the amount of money that you have for your down payment and your closing costs. We removed it. It wasn't the cash that killed the deal. It was the inability to source it. If you can't show on paper, or if you can't show a paper trail, the money doesn't count. And that leads me, the team around you can make or break your deal. I'm going to repeat that. The team around you can make or break your deal. You can have good income, good credit, perfect paperwork, and still lose that house because your team falls apart. I've seen bad attorneys who slow down everything, real estate agents who don't know how to communicate, and loan officers, yes, loan officers too, loan officers who move too slow, they don't run their numbers properly, or they have processors who just miss deadlines because they lose your paperwork. Buyers and partners not on the same page. If you're buying with your spouse and you guys have two different pages or like this, you guys will lose the deal. Here's the story. I had a deal where everything was perfect, but the attorney didn't order the title report on time. It delayed the closing. The seller got frustrated and the deal fell apart. Unfortunately, it happens. Sometimes it's not your mistake. You could have did everything right, but it's who you trusted. And that's exactly why avoiding these 5 lessons matter more than you think. Everything you just learned won't matter if you make this next mistake. And buyers are making them right now. Because New York City just changed the rules. And if you don't know or if you don't understand how ADUs can increase what you qualify for, you could be leaving 6 figures on the table. So before you do anything, make sure you tap the video right here, the one on ADUs and how they can boost your loan approval and build long-term wealth. This is a strategy almost nobody's talking about, and it could be the difference between approved or denied.